Welcome to Kitco News and our continuing coverage of the virtual Denver Gold Forum. Here to talk about the health of the gold market is John Reade, Chief Market Strategist at the World Gold Council. John, it's always a pleasure to talk with you. Thank you very much for joining us today.
Thank you. It's a pleasure.
There's been a lot of excitement in the gold market. We've seen prices push to record highs above $2,000 an ounce. Things have come off, things have slowed down a little bit. What are your thoughts on what the price action that we're seeing in the gold market?
Yeah, well, it's clear that we're in a period of consolidation now. We saw gold go up above $2,000 an ounce and held there for a few days. But if you looked at, and I'm not a technical analyst, but you have to pay attention to some things on charts. If you look at some measures of momentum, I look at a simple relative strength indicator. Gold was looking overbought. To be frank, I think in the first example I've seen at the World Gold Council, we even put out a report saying that we might be approaching a correction, and indeed that's happened. So we've corrected, consolidated, and certainly at the time of recording, we're still above $1,900 an ounce, and it's probably a healthy thing for the market, to be honest. What I would say is that there's lots going on in gold at the moment, and I've been involved in the gold industry in one form or another for nearly 35 years now, as you can probably see from the bags under my eyes. I can't remember a time that the makeup of gold demand has changed so much. I mean, we're all focused on the price, obviously, and the price has done very well this year. Investment demand, at least certain aspects of investment demand, has been very strong, which obviously is really positive. But other aspects of the market have been profoundly weak. We saw a complete collapse in consumer demand in the first half of the year. And fortunately, so far, investment demand, particularly from North America and Europe, has been more than enough to offset that consumer weakness. But now that we're in a consolidation phase and we're seeing less visible investment buying of gold, it does raise questions about where we could end up in the balance of the year.
Well, and I was going to say, do you think investment demand continues? We have seen it slow down. We've actually seen some outflows now, which was surprising, compared to the first half of the year. Is that investment demand for ETFs solid, do you think?
I think it is solid. And yes, we have seen outflows, but even in previous bull markets, you don't see inflows every day. Even in a year when gold prices go up strongly, there are pauses and slight retracements. I think you're right to be asking about the ETF market, because I think it's probably the most relevant, observable indicator of investment demand in the gold market at the moment. And I think it is fairly solid, perhaps more solid than even I was expecting. We did see, when COMEX and the OTC market dislocated quite violently back in March, I think we've seen some investors move their positioning from the COMEX futures market into both the OTC market, but also into the ETF market as well. So that's partly the reason I think we saw such strong inflows into North American ETF products in April, May, June, July, and even the early part of August. What did concern me, though, is because perhaps the nature of the investment into the ETFs had changed because of this migration. We might see a deeper correction. And apart from a brief trade down in illiquid early Asian trading, we've actually held the $1,900 pretty well. And it does seem as if most of the ETF buying that we've seen this year has been pretty steady, as in it's held on to those positions rather than taken fright in the face of what was initially quite a quick correction, even though things have stabilized now. So I think the ETF investors have shown their mettle, to make a bad pun, and I would expect to see investment demand strong in a balance of 2020 and into next year as well. There's too much risk and uncertainty out there at the moment, and that's usually a very strong driver of investment flows into gold.
How much of that is priced into the market already? We do talk about all of this uncertainty. We talk about interest rates. We just heard from the Fed. They're not raising interest rates until, through 2023. How much of this is priced in already, do you think?
Well, if you look at the relationship between gold and real interest rates, that's a very tight relationship. And what I'd say, looking at that at real US 10-year Treasury yields, they're pricing in, or rather, gold is pricing in the current level very well. It's not that there's a big gap opened up, in my opinion, or at least on the charts that I look at. Well, what that really says to me is that we probably can see gold going higher, um, in one of two cases, or potentially both at the same time. If real yields continue to trade lower, gold probably goes higher on the back of that. But similarly, if we see weakness in the US dollar, because, and this is one thing about the rally that we've seen in gold over the last 12 months that I find really interesting, is that it's taken place in an environment where the dollar has been stable, even firm at times, which I think has important implications. First of all, I think the dollar gold price can go up a lot if the dollar were to start weakening. Now, I'm not going to get involved in the arguments whether we're in a strong dollar environment or a weak dollar environment. If you want to play that game, then Twitter is a wonderful place to see people slagging each other off all the time. But it is true, if you look at longer term charts, that the dollar, certainly on a DXY basis, looks firmer rather than weaker. If that were to go through a weakening phase, that would be obviously very beneficial for the dollar gold price. But so far, I think the interesting thing for me is the fact that all investors in all currencies, and indeed producers in all currencies, have been able to benefit from this increase in the gold price this time. And that's quite different from what we saw previously, say, in 2011, when the dollar gold price was going up in a background of a weak US dollar. Now, that's great for a US dollar-based investor, but there are many investors out there that don't use the dollar as their base currency, and lots of producing companies that don't have costs in US dollars as well. So it's a much broader rally this time, and I personally think more sustainable because of the extraordinary times that we're in, whether that's in terms of monetary policy action or whether it's in terms of fiscal policy by governments. As you say, interest rates aren't going up again until at least 2023, according to the Fed, but I wonder whether I'll ever see an interest rate hike again, and I'm not that old. Certainly, and if you look down the line, we could be in a position where inflation picks up at some point, and interest rates still remain very low. That could drive negative. That could drive real yields even more negative. That could be very supportive for gold too.
Just to pull back a little bit to talk about currency, gold and other currencies. To me, it does feel like a double-edged sword in that higher gold prices in Indian markets and Asian markets have been a big detriment to physical demand in jewelry. What are your thoughts then? Like, does there come a point where consumers say, you know what, I don't care what the price is, I have to buy gold?
Yeah, it's an interesting question, isn't it? Certainly, high gold prices have played a role in weak consumer demand this year, but I don't think it's been the most important factor. I think the most important factor is the economic damage of the lockdowns associated with the coronavirus. We've had consumers unable to access jewelry shops to buy gold. And even if they have been able to access them, maybe their income is lower, maybe they've lost their jobs, maybe their wealth has been destroyed in some way. So they don't have the money to spend. High prices, in my experience, in important consumer markets do lead to a short-term slowdown in purchases. But once the price stabilizes, consumers get used to that higher price. And certainly in some markets, in some cultures, gold gets bought, perhaps mess gold in mass terms. A lot of people perhaps set aside a budget in rupees or in other currencies to buy gold for a wedding or a festival or a holiday. So maybe their 100,000 rupees buys fewer ounces of gold, but they will, when they think the price has stabilized, I expect they will come back on the buy side for gold. But I think that's not going to happen in tremendous quantities this year. I mean, speaking to my colleagues around the world, and I was speaking to Mukesh Kumar, who does research for us based out of Mumbai, there has been some improvement in Indian demand in the third quarter compared to the second quarter, but it's going to be substantially lower compared to the third quarter of 2019. And I've said elsewhere, even if we get a rapid recovery in economies, in gold demand, from now onwards, consumer demand is going to be weak this year. It never does drive prices higher. It rather provides support when we see a correction. But it's certainly not going to be the factor in the gold supply demand balance this year that we would have expected at the beginning of the year. But then again, we didn't expect investment demand to be as strong either. And it is investment demand that drives prices higher. So in an environment where consumer demand is weak, we don't necessarily have to worry about that in the short term, at least, as long as investment demand is strong. But you're right to be asking the questions about consumer demand, because it really is important for the long-term health of the gold industry. And I'm watching very carefully to see how that's coming back in various markets.
Does it come back, do you think?
It comes back, it takes time, and if prices stay materially higher than they were, before this happened, it'll probably come back in reduced quantities, just simply because of price elasticity of demand and wealth effects. But during my career, gold's gone from $250 an ounce to, well, ignoring this year, call it $1,900 an ounce. Indians still buy an awful lot of gold, and the Chinese have massively increased the amount they buy in jewelry. So it does show you that higher prices on their own aren't a handicap for jewelry demand in rapidly growing emerging markets. So I'm not worried about the long-term implications of higher gold prices on jewelry demand, but I do recognize that it'll have some impact in the shorter term.
In March, we saw the blowout spreads between futures and spots, massive supply disruptions. Have we fixed those issues?
I mean, I think the issues have partially been fixed. And I would say that the problems have been concentrated in the COMEX futures market and its ability to integrate properly with the broader international gold market. I mean, historically, the spread between the active COMEX future and the OTC market would have been about $2, with COMEX trading at $2 over the OTC market. At one point, that blew out to more than $75 an ounce. Now, I've been looking at this closely. I tweet out about it on most days. It's currently about $8, $9, and has been stable around sort of $6 to $10 through September to date. So it's not back to normal, but it's better. So that the spread is tighter and it's less volatile. And I think that's an indication that the market is improving. It will take time to get back to where it was before, if it ever does. I'll tell you the reason for that is simply that in order for COMEX to connect properly with the rest of the gold market, there has to be a fair amount of risk capital that is provided by primarily the banks, some trading houses and funds, but primarily the banks, to arbitrage these two markets away. And because of the volatility in the spread between the two markets, I think the amount of risk capital that banks are prepared to throw at this trade has greatly reduced. Now, evidence that the spread is stabilizing and narrowing and becoming more predictable should encourage a bit more money to come back into this market. And it's really important, I think, because one of the things we're trying to do is develop the gold market, and we want investors to be able to access the gold market, with as much liquidity, with as lower costs. And unfortunately, because of the issues that COMEX suffered, the cost of medium to longer term ownership of gold on COMEX now is much more than it used to be. It's costing you a lot to roll from one future to the next. And whilst those high costs remain, it's deterring some investors from investing in COMEX futures. Now, you could say, well, they could buy OTC positions or they could buy ETFs, and some of them have done that. But not everyone can. There are some funds that are set up to only own US traded futures, and they'll be looking at the costs involved in being long gold and perhaps not participating at all. So, it's not a competition, and I think this is often misrepresented in the press as like, COMEX losing out to London, or London winning compared to. It doesn't work like this. This is a market which thrives upon interlinks, where liquidity in a big market like COMEX and a big market like the OTC market works best when you can arbitrage effectively between the two. Now, that's not working as well as it used to, and hopefully it'll come back soon. There are signs of it recovering, but it'll take a while before those very wide and very volatile spreads fall out of the data sets that risk managers use to assign capital.
So, John, I think the problem with the results of the blowout in spreads is that we've seen a reduction of middlemen in the market. A lot of banks took big hits and they basically just left the market. Do they come back, do you think?
Yeah, it's interesting. I mean, I've seen a few reports from banks' quarterly results about the impact of this. It wasn't completely clear whether those were mark-to-market losses or realized losses. And certainly spreads have come back. So I suspect there were probably some realized losses. Most of it's mark-to-market. What matters to a bank is how much money it can make by being in the gold market. And if I had to choose between high prices, volatility, lots of interest, lots of buying, sometimes selling, and admittedly, volatile spreads and other factors, or a quiet market where nobody was doing anything, I'd much rather take the volatility as an observer of the gold market. Yeah, some people probably got carried out on a mark-to-market basis, maybe even actually lost some real money, realized some losses. But there's always, in my experience, there's always potential new entrants to come into the market. And if some of the people leave, then likely we'll see more participants come into the market. Forever is a long time in banking. So, you hear investment banks saying they're getting out of commodities or they're getting out of gold. 5-10 years later, they often try it again. I have seen that from places I worked at previously.
Do you see higher gold prices by the end of the year? Has the market seen its best days for the year?
It's difficult to say. I mean, we're clearly consolidating at the moment. We've seen most of the buyers who bought gold hold on to their positions, and the rate of new purchases has slowed, thinking specifically on the investment side. We're seeing a bit of a recovery coming through in consumer demand, and probably we're going to see some more supply in the second half of 2020 as well. Fewer disruptions of mine supply from coronavirus, and probably some more scrap coming back to market now that people can get into the shops. So it really is going to come down to, will investors stay buying or stay motivated to buy gold? All the research that we've done using our valuation framework or our quorum valuation tool, available for free on our website, would suggest that investment demand should be supported in this current environment. And the fact that interest rates are going to stay low for a very long time, the fact that there is the potential for short-term deflation, potentially longer-term inflation, I think it is going to keep investors very focused. Another reason for the bags under my eyes is not just because of my age, but because I'm spending an awful lot of time in front of Zoom, in front of Teams, in front of as many conferencing apps that I've ever heard of, speaking to investors about gold. The amount of interest that we're seeing from mostly institutional investors who we speak to is unprecedented, certainly in my time at the World Gold Council, and reminds me around the time of the global financial crisis back in 2009. So I think there is certainly the potential for more investment demand to come in for gold, and that's going to be the thing that will take gold higher.
John, thank you very much for your time. Some cucumbers on the eyes, they'll help reduce those bags, but you do look fantastic. You do look well rested. So for what has been a chaotic time.
Thank you very much. It's been a pleasure.
Thank you for joining Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.